The world of cryptocurrency is a bit like the Wild West, unpredictable, thrilling, and full of opportunities for those brave enough to venture into its uncharted territories. But while the headlines often focus on Bitcoin's meteoric rises or Ethereum's smart contract dominance, there's a quieter revolution happening beneath the surface. Emerging crypto protocols, those new, innovative blockchain projects, are quietly reshaping the landscape, offering investors a chance to get in on the ground floor of the next big thing. The question is, how do you navigate this volatile, fast-moving space without getting burned? How do you separate the diamonds from the dirt? The answer lies in crafting a smart, informed investment strategy tailored to the unique challenges and opportunities of these nascent protocols. Let's start with the basics. Emerging crypto protocols are essentially new blockchain-based systems that aim to solve specific problems or improve upon existing technologies. They might focus on scalability, privacy, interoperability, or even entirely new use cases like decentralized finance, DeFi, or non-fungible tokens, NFTs. Unlike established cryptocurrencies like Bitcoin or Ethereum, these protocols are often in their infancy, with small market caps, limited adoption, and a high degree of uncertainty. But with that uncertainty comes potential, massive potential. Early investors in Ethereum, for example, saw returns that would make even the most seasoned Wall Street trader blush. The trick is figuring out which of these new protocols have the staying power to become the next Ethereum, and which are destined to fizzle out. So, how do you approach investing in these emerging protocols? The first step is understanding the landscape. Cryptocurrency is not a monolith. It's a vast, interconnected ecosystem with countless niches and sub-niches. Some protocols are designed to compete directly with Ethereum, offering faster transaction speeds or lower fees. Others are building entirely new paradigms, like decentralized autonomous organizations, DAOs, or blockchain-based identity systems. To make informed investment decisions, you need to understand not just the technology behind these protocols, but also the problems they're trying to solve and the markets they're targeting. This requires a mix of technical knowledge, market research, and a healthy dose of intuition. One of the most important factors to consider when evaluating an emerging crypto protocol is the team behind it. In the early days of a project, the team is everything. They are the architects of the vision, the builders of the technology, and the driving force behind its adoption. A strong team can turn an ambitious idea into a groundbreaking reality, while a weak or inexperienced team can doom even the most promising project to failure. So, what should you look for in a team? First and foremost, do they have a track record of success in the crypto space? Have they been involved in other projects that have delivered real value or achieved significant milestones? A team with a proven history of execution is far more likely to succeed than one that's starting from scratch. Transparency is another critical factor. Are the team members open about their goals, progress, and challenges? Do they communicate regularly with the community, providing updates and addressing concerns? Transparency builds trust, and trust is essential in a space as speculative and volatile as cryptocurrency. A team that operates in the shadows or avoids tough questions is a red flag. You want a team that's not only capable but also accountable. Technical expertise is equally important. Does the team have the skills and experience necessary to bring their vision to life? Blockchain technology is complex, and building a successful protocol requires a deep understanding of cryptography, distributed systems, and software development. Look for team members with relevant backgrounds, whether it's in computer science, engineering, or blockchain-specific fields. It's also worth checking if they have advisors or partners with strong technical credentials. A team that's out of its depth is unlikely to deliver on its promises. But technical expertise alone isn't enough. The team also needs to have a clear vision and the ability to execute on it. Do they have a well-defined roadmap with achievable milestones? Are they making steady progress, or are they constantly missing deadlines and pushing back launch dates? A team that can't execute is a team you don't want to bet on. Execution is where many projects fail, even those with great ideas and strong technical foundations. The Binance team is an example of a good, strong team. Binance Holdings Limited, branded Binance, is the largest cryptocurrency exchange in terms of daily trading volume of cryptocurrencies. Binance was founded in 2017 by Changpeng Zhao, a developer who had previously created high-frequency trading software. Ethics and integrity are also crucial. The crypto space has its fair share of bad actors, from scam artists to opportunists looking to make a quick buck. A team with a history of failed projects, broken promises, or questionable behavior is a major red flag. Do your due diligence. Research the team's background, read reviews, and look for any warning signs. Remember, investing in emerging protocols is inherently risky, and the last thing you want is to bet on a team that can't or won't deliver. Finally, consider the team's ability to inspire and mobilize a community. Cryptocurrency is as much about people as it is about technology. A strong, engaged community can help a project gain traction, attract developers, and build a network effect. Does the team have a track record of fostering community engagement? Are they active on social media, forums, and other platforms? A team that can rally people around its vision is far more likely to succeed than one that operates in isolation. In short, the team behind a crypto protocol is its backbone. They are the ones who will determine whether the project succeeds or fails. By evaluating their track record, transparency, technical expertise, execution ability, ethics, and community building skills, you can gain valuable insights into the project's potential. Investing in emerging protocols is inherently risky, but by betting on the right team, you can tilt the odds in your favor. After all, in the world of cryptocurrency, the difference between a moonshot and a dud often comes down to the people behind the project. Another key consideration is the protocol's underlying technology. What makes it unique? Does it offer a genuine improvement over existing solutions, or is it just a copycat with a fresh coat of paint? In the crypto world, innovation is the name of the game. Protocols that bring something new to the table, whether it's a novel consensus mechanism, a groundbreaking use case, or a more efficient way to process transactions, those are the ones most likely to succeed. But innovation alone isn't enough. The technology also needs to be feasible. Does the protocol have a clear roadmap for development? Are there any major technical hurdles that could derail the project? These are the kinds of questions you need to ask before investing. Of course, technology and team are only part of the equation. Market dynamics play a huge role in the success or failure of any crypto protocol. Who is the target audience? Is there a genuine demand for the problem the protocol is solving? How competitive is the market? Even the most innovative protocol will struggle to gain traction if there's no real need for it. That's why it's crucial to look at the broader market context when evaluating an investment. For example, the rise of DeFi has created a huge demand for protocols that can facilitate lending, borrowing, and trading without intermediaries. If you can identify a protocol that's well-positioned to capitalize on this trend, you could be looking at a lucrative opportunity. Timing is another critical factor. The crypto market moves at lightning speed, and getting in at the right time can make all the difference. Too early, and you might be stuck waiting years for the protocol to gain traction. Too late, and you could miss out on the biggest gains. The key is to strike a balance between being an early adopter and avoiding unnecessary risk. One way to do this is to look for protocols that have already achieved some level of validation, whether it's through partnerships, pilot projects, or a growing community of users. These are signs that the protocol is gaining momentum and could be poised for a breakout. Diversification is also essential when investing in emerging crypto protocols. The crypto market is notoriously volatile, and even the most promising projects can fail. By spreading your investments across multiple protocols, you can reduce your exposure to any single point of failure. This doesn't mean throwing money at every new project that comes along. Quality still matters more than quantity, but it does mean being strategic about where you put your money. A well-diversified portfolio might include a mix of high-risk, high-reward protocols and more stable, established projects. The goal is to balance potential upside with downside protection. Risk management is another crucial aspect of any investment strategy, and it's especially important in the world of emerging crypto protocols. The truth is, most of these projects will fail. That's just the nature of the game. But by carefully managing your risk, you can minimize your losses and maximize your chances of success. One way to do this is to set clear investment criteria and stick to them. For example, you might decide to only invest in protocols with a working product, a strong team, and a clear market need. You might also set limits on how much you're willing to invest in any single project. The idea is to create a framework that helps you make disciplined, rational decisions, even in the face of FOMO, fear of missing out. Another important risk management tool is due diligence. In the crypto world, scams and fraudulent projects are unfortunately all too common. That's why it's essential to do your homework before investing in any protocol. This means reading the white paper, researching the team, and scrutinizing the project's claims. It also means staying informed about the broader market and regulatory environment. Cryptocurrency is a rapidly evolving space, and what's legal and acceptable today might not be tomorrow. By staying informed, you can avoid costly mistakes and make smarter investment decisions. Finally, it's worth mentioning the role of community in the success of emerging crypto protocols. Unlike traditional investments, where the value of a stock or bond is largely determined by financial metrics, the value of a crypto protocol is often driven by its community. A strong, active community can help a protocol gain traction, attract developers, and build a network effect. That's why it's important to pay attention to the community surrounding any protocol you're considering investing in. Are the developers engaged and responsive? Is there a vibrant, supportive community of users? These are signs that the protocol has the potential to grow and thrive over the long term. If you made it this far, you're probably considering investing in crypto. If you would like a breakdown of any of these concepts or terms, let me know in the comments. Investing in emerging crypto protocols is not for the faint of heart. It's a high-risk, high-reward game that requires a combination of technical knowledge, market insight, and disciplined risk management. But for those willing to put in the work, the potential rewards are enormous. By focusing on strong teams, innovative technology, market demand, and community support, you can increase your chances of finding the next big thing in crypto. And while there are no guarantees in this space, one thing is certain. The future of cryptocurrency is being built right now, and the opportunities are endless for those who know where to look. So, do your research, stay informed, and don't be afraid to take calculated risks. The next Ethereum could be just around the corner.